Hello students, Principles of Insurance, Unit 2. Let us discuss about insurance business and market. In this unit, we will be focusing on management of risk by individuals, fixing of premiums, reinsurance and its importance for insurers, role of insurance in economic development and social security, contribution of insurance to the society, constituents of insurance market, operations of insurance companies, specialist insurance companies, role of regulators, other bodies connected with insurance. Management of risk by individuals. Individual risk management refers to the identification of pure risk faced by an individual or family and to the selection of most appropriate technique for treating such risk. To reduce risk element, certain basic steps have been allowed under individual risk management process. We have to identify the potential loss. Potential loss should be evaluated in terms of loss frequency and loss severity. Appropriate method for treating loss, exposure. Risk management program must be implemented and it should be properly administered. The process of risk management for individuals begins with identifying of potential loss which can arise due to potential risk, property risk, liability risk. Potential risk, risk arising due to loss of earned income to the family because of premature death of family head, insufficient income and financial assets during retirement, loss of earned income from unemployment. Coming to the property risk, physical damage to a home and personal property because of fire, because of lightning, or natural calamities like flood, earthquake, etc. Theft of personal property, including money, securities, etc. Theft of car, motorcycle, or physical damage to the vehicle, that is related to the property risk. Coming to the liability risk, legal liabilities arising out of defamation of character, legal liability arising out of negligent operations, legal liability arising of business or professional activities. Next, evaluation of potential loss. Estimating the frequency and severity of potential loss is the most appropriate technique which is used to deal with the risk. The chance that your home will be totally destroyed by certain natural calamity, thunder, storm, flood, earthquake, etc., is relatively small, but the severity of the loss can be catastrophic. Such losses should be insured because of their catastrophic potential. Selection of appropriate technique for handling the loss. Losses are managed by selecting the most appropriate method for handling the potential loss. The methods are loss control, avoidance, retention, non-insurance transfers, insurance. Loss control. It is a method by which frequency and security of loss is controlled. Theft can be prevented by locking the car, removing the key from the ignition, or by installing an anti-theft device. Avoidance. Apart from controlling loss, the other substitute for preventing loss to occur is avoidance, a method for handling potential loss. You can avoid risk by not traveling on a lonely road in the night and not to drive a vehicle with poor brakes. Retention. Retention means the amount of loss that you bear it all some loss occurs. Risk retention can also be further classified as active risk retention or passive risk retention. Non-insurance transfers. It is an instrument by which a pure risk is transferred to a party other than an insurer. Risk associated with a defective music system is transferred to a retailer by purchasing an extended warranty contract that makes the retailer responsible for repairs after warranty expires. Insurance. It is one of the cheapest mode generally used by individuals of risk management. Individual use life and non-life coverage for personal, property and liability risk. Review the program periodically. The risk management must be reviewed periodically to find out deviations. If these deviations are significant, it requires a modification or complete renewal of the whole model. Management of risk by insurers. Risk management activities occur before, during, and after loss. Most planning is done before loss occurs. Losses involve natural disasters, emergencies, also require action. While loss is happening after a loss, the risk manager must file insurance claim and analyze the loss pattern. Risk management process requires some steps: defining the objective of risk management, identify and measure potential loss, evaluate the potential loss, select some appropriate technique to mitigate the loss, implement and review the program. When developing a risk management program, the risk manager should have a good notion of the maximum possible loss and the maximum probable loss. The maximum possible loss to the total amount of financial harm a given loss could cause under the worst circumstances. Maximum probable loss is the most likely maximum amount of damage a peril might cause under typical circumstances. Once again, the maximum possible loss refers to the total amount of financial harm a given loss could cause under the worst circumstances. Maximum probable loss is the most likely maximum amount of damage a peril might cause under typical circumstances. Risk management is widely used by multinational companies, farmers, government organizations, small companies, and even by individuals. Different risky situation may give rise to different kind of losses. Loss from natural calamity may differ from accidental loss. When risk managers deal with these risks, they must have certain objectives pre and post loss. Identify and measure potential loss exposures. The second and foremost step is to identify the potential loss exposures. Risk managers must have to update their knowledge about the firm, the market in which it operates, the legal, social, economical, and political environment in which the firm is operated. Okay, some of the major loss exposures like loss due to retirement, unemployment, disability, death, liability loss, property loss, etc., can be identified and measured with the help of financial statements, physical inspection, interaction with experts, etc. Evaluating the potential loss. The next step to evaluate and measure the impact of the loss step involves estimation of the potential frequency and security of loss. Loss frequency refers to the probable number of losses that may occur during the given period of time. Loss survival refers to the probable size of the losses. Once the frequency and security of each type of loss exposures are estimated, various loss exposures can be ranked according to their relative importance. After the frequency and security of each type of loss exposures are estimated, various loss exposures can be ranked according to their relative importance. And once identification and evaluation is completed, we can concentrate on selecting appropriate technique for loss. The next step in the risk management process is to select the most appropriate technique for treating loss exposure. So for this we have risk control and risk financing. No monetary compensation is involved in risk control. Loss controls are those actions which reduce the expected cost of losses by reducing the frequency and severity of loss. Major risk control techniques involve avoidance, prevention, loss reduction. Risk financing. This refers to the manner in which the risk control measures that have been implemented shall be financed. It refers to techniques that provide for the funding of loss. Major risk financing techniques include risk retention, non-insurance transfers, commercial insurance. Reinsurance and its importance for insurers. Reinsurance, also known as insurance for insurers or stop loss insurance, is the practice of insurers transferring portions of risk portfolios to other parties by some form of agreement to reduce the likelihood of having to pay a large obligation resulting from an insurance claim. The party that diversifies its insurance portfolio is known as a ceding party. The party that accepts a portion of the potential obligation in exchange for a share of the insurance premium is known as a reinsurer. Just as insurance policy holders pay premiums to insurance companies pay premium to the reinsurers. The price of reinsurance, like the price of insurance, depends on the amount of risk. Reinsurance often have the word RE in their names, for example, Allianz Re, Swiss Re, etc. Reinsurance lets insurers cover their risk by recovering some or all of the amounts they pay to claimants. By covering the insurer against accumulated individual commitments, reinsurance gives the insurer more security for its equity and solvency and more stable results when unusual and major events take place. Reinsurance reduces net liability on individual and catastrophe protection from large or multiple losses. Insurers may underwrite policies covering a larger quantity or volume of risk without excessively raising administrative cost to cover their solvency margin. It gives ceding companies the capacity for increasing their underwriting capabilities in terms of the number and size of risks. Reinsurance makes substantial liquid assets available for insurers in case of exceptional loss. The reinsurer has all the rights for accepting or denying a facultative reinsurance proposal. Facultative coverage protects an insurer for an individual or specified risk or contract. A reinsurance agreement is effective for a set time period rather than on a per risk or contract basis. The reinsurer covers all or a portion of the risk that the insurer may incur. The reinsurer also reimburses the insurer for processing, business acquisition, and writing costs. Role of insurance in economic development and social security. In modern economic and financial system, the insurance sector plays a very important role. It provides individuals, corporations, and other organizations a mechanism for transferring some of the non-entrepreneurial risk that they face. It provides a means for mobilizing long-term savings and investing them profitably in the capital market. It directly stimulates the growth of the capital market. It complements state social insurance programs, especially in the areas of pensions, disability, and healthcare. How insurance is helping economic development and social security to the society can be explained by the help of some points. Let us discuss some 7 to 8 points which focuses on the role of insurance in helping the economic development and social security. First point is regarding saving and insurance. Insurance companies lead to economic development by mobilizing savings and investing them in productive activities. Indian insurance companies are able to mobilize long-term savings to support economic growth, and also they facilitate economic development by providing insurance cover to a large segment of our people as well as to business enterprise throughout India. Capital formation and insurance. Capital formation may be defined as increase in capital stock of the country, consisting of plant, equipment, machinery, tools, building, means of transportation, communication, etc. The process of capital formation envisages three essential steps: real saving, the act of investment, mobilization of saving through financial and non-financial intermediaries to be placed at the disposal of investor. The contribution of insurance companies in the process of capital formation appears at all these stages. Insurance services act as a tool mobilizing savings, function as a financial intermediary at times, and also indulge in direct investment. The importance of Indian insurance industry is gauged by the fact that annual amount of investable funds of LIC and GIC and its subsidiaries amounts to more than 20,000 crore and 10,000 crore are invested in nation building activities, housing and other infrastructural areas. Increased employment. Prior to liberalization of insurance sector in India, the opportunities for employment in insurance were limited with LIC of India as sole employer. But after liberalization and the opening up of private sector, the private sector plays a very important role, and it creates good employment opportunities. Insurance as financial intermediary. Financial intermediaries perform the function of channelizing saving into domestic investment. They facilitate efficient allocation of capital resources, which in turn improve productivity and economic efficiency, which result in a reduced capital output ratio. The insurance companies perform extremely useful function in economy as financial intermediaries. They reduction in transaction cost, creating liability, facilitating economies of scale in investment. So Insurers help in reducing transaction costs in the economy by collecting funds from policyholders, investing the same in different projects scattered over different regions. Policyholders, in case of loss, are not required to wait for a long period for the amount of claim. It improves their liquidity. Insurers are in position of financing large projects, railways, power projects. These large projects create economies of scale, facilitate technological innovation and specialization, thus promote economic efficiency and productivity. Similarly, promotes trade and commerce. Increase in GDP is positively correlated to growth of trade and commerce in economy. Whether it is production of goods and services, domestic or international trade, or venture capital projects, granting of loans by banks for purchase of assets, insurance coverage is demanded everywhere. Thus, insurance covers, promotes specialization and flexibility in the economic system that play a contributory role in healthy and smooth growth of trade and commerce. Facilitates efficient capital allocation. Insurance provides cover to large number of firms, enterprises, businesses also deploy their funds in number of investment projects. They promote efficient and productive allocation of capital resources, which in turn lead to increased productivity and efficiency in the system. Encourages financial stability and reduces anxiety. Insurer promotes financial stability in economy in ensuring the risk and losses of individuals. It relieves the tensions and anxiety of individuals by securing the loss of their lives and assets. Reducing burden on government exchequer. Insurance companies, particularly life insurance, provide a variety of insurance products covering needs of children, women, and aged under social security network and thereby reduce the burden on government exchequer in providing these services. So therefore, insurance companies play an important role in economic development of the country. Operations of insurance companies. The different operations of insurance companies are rate making, underwriting, production, settlement, reinsurance. Rate making refers to the pricing of insurance and calculation of insurance premium. The rate is the price per unit of insurance. Actuary is a highly skilled mathematician who determines the rates and premium by using the company's past loss experience and industry statistics. Underwriting, it is a process of selecting, classifying and pricing applicants for insurance. Underwriter is a person who decides to accept or reject an application. The main objective of underwriting is to produce a profitable book of business. Production, the term production refers to the sale and marketing activities of insurers. Agents who sell insurance are frequently referred to as producers. Life insurers have an agency or sales department. This department is responsible for recruiting and training new agents and for the supervision of general agents, branch office managers, local agents. Property and casualty insurers have marketing departments to assist agents in the field. Special agents may also be appointed. Settlement. Every insurance company has a claims division or department for adjusting claims. The basic objective of claims settlement, verification, fair and prompt payment of claim, personal assistance to the insured. First objective in settling a claim is to verify that a covered loss has occurred, and it involves determining whether a specific person or property is covered under the policy, extent of the coverage. Second objective is the fair and prompt payment of claim. If the valid claim is denied, the fundamental social and contractual purpose of protecting the insured is defeated. The third objective is personal assistance to the insured will be provided. Reinsurance. It is an arrangement by which the primary insurer that initially writes the insurance transfers to another insurer called the reinsurer part or all of the potential losses associated with such insurance. The primary insurer that initially writes the insurance is called the ceding company. The insurer that accepts part or all of the insurance from the ceding company is called the reinsurer. The benefits of reinsurance, it increases underwriting capacity, it stabilizes profits, it reduces the unearned premium reserve, provides protection against a catastrophic loss. Many insurance and reinsurers are now using the capital markets as an alternative to traditional reinsurance. Some insurance and reinsurers are using the capital market to gain access to the capital of institutional investors. They are securitizing the risk. Securitization of risk means that an insurable risk is transferred to the capital market through the creation of financial instrument such as catastrophe bond, future contract, options contract, or other financial instruments. Operations of intermediaries. Intermediaries are a vital link between the insurer and the insured. They act as a bridge between the insurer and the insured, and thereby helping the insurance companies to increase breadth and depth of the insurance market. They are a key distribution channel to an insurer. The intermediaries associated with insurance business are agents and surveyors and loss assessors, brokers, third-party administrators, and banks. Agents are just like retailers of any customer product who help in selling and distributing the product. An agent is a person licensed by the controller of insurance to do insurance business. After obtaining the license, agents have to enroll with the insurance company to be authorized to work as agents. Insurance is a financial product requiring technical and product knowledge. In order to develop agents as independent and competent financial advisors, Insurance Regulatory Development Authority has stipulated compulsory training followed by an eligibility test for agents. Those who successfully complete the test and training are granted license by Insurance Regulatory Development Authority. Insurer-agent relationship can take a number of different forms. In some markets, agents are independent and work with more than one insurance company. In others, agents operate exclusively, either representing a single insurance company in one geographic area or selling a single line of business for each of several companies. Agents can operate in different forms: independent, exclusive, insurer, employed, and self-employed. Surveyors and loss assessors. Surveyors and loss assessors are independent professionals appointed by an insurance company to assess the loss or damage when a claim is notified under a policy issued by them. An insurance surveyor must be duly licensed by IRDA. Insurance companies allot them work depending on their competence in the relative field. The duties of a surveyor are to investigate and confirm the cause of loss, assess the quantum of loss, determine the liability of the insurers, advise the insured to take necessary steps to contain the loss, act on behalf of the insurance company in disposal of salvage to realize maximum value. A surveyor is an independent professional who is impartial and objective in his assessment. Brokers. IRDA has allowed brokers to enter the insurance industry to ensure the quality of service provided to the end customer. IRDA has created 4 categories of brokers and specified the minimum capital requirement for each of the category. The functions of brokers are specified by IRDA and include provision of technical advice, advice on developments in the insurance market and the law, providing written acknowledgements and progress reports, and assisting the negotiation of claims. Third-party administrators. The 4 state-owned general insurers, National Insurance, New India Assurance, Oriental Insurance, United India Insurance, have empaneled over 24 third-party administrators for managing Mediclaim policy. All new Mediclaim policies will be serviced by third-party administrators. Insurers have allocated division falling under each regional office to an external third-party administrators. The data in respect of all new policies will be forwarded to the third-party administrators, who within 7 days will issue an identity card and guidebook detailing claim procedures. The third-party administrators will Also be provided with the float funds by insurance companies to settle claims in the hospitals. The third party administrators empaneled by the four insurers have a network ranging from expensive hospitals to a small nursing home. The Reserve Bank, in recognition of the symbolic relationship between banking and insurance industries, identified three routes of participation in the insurance business: providing fee based insurance services without risk participation, investing in an insurance company for providing infrastructure and service support, setting up of a separate joint venture insurance company with risk participation. Over 20 banks have tied up with public and private sector insurance companies to sell their products. The synergy between some products um, makes banks ideal partners of insurance companies. In addition, through this partnership, new insurance companies get a ready-made consumer database and higher reach to compete with public sector insurance companies. Insurance specialists. We have Life Insurance Corporation of India, ICICI Prudential Life Insurance Company, Bajaj Allianz General Insurance Company Limited, and Allianz Bajaj Life Insurance Company Limited, ICICI Lombard General Insurance Company Limited, National Insurance Company Limited, New India Assurance Company, Oriental Insurance Company, United India Insurance Company, Tata AIG General Insurance Company, HDFC General Insurance Limited. Role of regulators and other bodies connected with insurance. The Insurance Regulatory and Development Authority of India is an autonomous statutory agency with regulating and promoting the insurance and reinsurance industries in India. It was constituted by the Insurance Regularity and Development Authority Act 1999, an act of Parliament passed by the Government of India. IRDAI is a 10-member body, including the chairman, 5 full-time and 4 part-time members. The functions of Insurance Regulatory and Development Authority of India are as follows: issuing, renewing, modifying, withdrawing, suspending or cancelling registrations, protecting policyholder interests, specifying qualifications, the code of conduct and training for intermediaries and agents, specifying the code of conduct for surveyors and loss assessors, promoting efficiency, promoting and regulating professional organizations connected with the insurance and reinsurance industry, levying fees and other charges, inspecting and investigating insurers, intermediaries, and other relevant organizations, regulating rates, advantages, terms and conditions which may be offered by the insurers not covered by the Tariff Advisory Committee under Section 64U of the Insurance Act 1938, specifying how books should be kept, regulating company investment of funds, regulating a margin of solvency, adjudicating disputes between insurers and intermediaries or insurance intermediaries, supervising the Tariff Advisory Committee, specifying the percentage of premium income to finance schemes for promoting and regulating professional organizations, specifying the percentage of life and general insurance business undertaken in the rural or social sector, specifying the form and the manner in which books of accounts shall be maintained, statement of accounts shall be rendered by insurers and other insurer intermediaries. Other bodies connected with insurance: Insurance Advisory Committee, Life Insurance and General Insurance Councils, Life Insurance Council, General Insurance Council, Insurance Information Bureau, Institute of Insurance and Risk Management. So, Insurance Advisory Committee. The Insurance Advisory Committee shall consist of not more than 25 members from various fields like commerce, industry, transport, agriculture, consumer forum, surveyors, agents, intermediaries, organizations engaged in safety and loss prevention, research bodies, and employees association in the insurance sector. The chairperson and the members of the authority shall be the ex officio chairperson and the ex officio members of the Insurance Advisory Committee. Life Insurance and General Insurance Councils. Under Section 69A of the Insurance Act 1938, the Insurance Association of India was established. It consists of all the insurers carrying on business in India as members, and as per provisions of Section 64C, the Act recommends the establishment of independent Life Insurance Council and General Insurance Council. Section 64F of the Insurance Act 1938 authorizes the authority to nominate members of the Executive Committee. Life Insurance Council. The Life Insurance Council will have an executive committee of 21 members, of which 2 will be from the IRDA and the rest from licensed life insurers. The committee will set up standards of conduct and practices for efficient customer service. It advises IRDA on controlling insurers' expenses and serve as a forum that helps mainly healthy market. It will create and manage a process for agent examination and certification. General Insurance Council. General Insurance Council is sustainable, profitable and growing non-life insurance industry in India. It is a body recognized as providing active leadership and authoritative collective voice for the non-life insurance industry in India. General Insurance Council will provide other services to member companies which benefit industry collectively, which support the mission, which can be provided without diversion of resources from the core functions and which cannot be done more effectively by any other body. Insurance Information Bureau. Insurance Information Bureau of India was promoted in the year 2009 by IRDA. IRDA recognizes the importance of data sharing policy and the need for a continuous, dependable system to collect and disseminate insurance data. The collection and dissemination of reliable and accurate numerical statistical data is important for any industry, especially for the insurance industry, which is essentially data oriented. Insurance Information Bureau has created a data warehouse. It enables insurers, other stakeholders, researchers to have easy access to validated data from one source. Insurance Information Bureau collects data from insurers, integrates the data into logical subject areas, stores the data in manner that accessible and understandable to decision makers, and delivers data information decision makers through report writing and query tools. Institute of Insurance and Risk Management, IIRM. IIRM is the educational initiative of the regulator IRDAI for education in insurance and actuarial science, with the sole aim of developing the required workforce for the entire insurance sector. The institute offers education through the regular and distance modes. So, with this, we got some idea of Unit 2 related to insurance business and market. Briefly, we have covered management of risk by individuals, management of risk by insurers. We have studied about the role of insurance in economic development, contribution of insurance to the society. We have studied about the role of regulators, other bodies connected with the insurance. Thank you very much.